This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed. Across Bloomberg platforms, Carol Massar, Tim Stenovec on this. Yeah, it is Tuesday.
A Fed Tuesday?
No.
No, tomorrow's a Fed Wednesday.
No. Is it?
Yeah, Mike McKee. Mike McKee is going to Washington as we speak. You can't sense when he's out of the building?
I do. Well, he sits right behind you, so you're like, Mike, where are you?
I see his bag and I say, Mike. So anyway,
all right.
Get some minutes tomorrow.
Okay,
right?
We do get Fed minutes, but it's not a Fed decision. That's not till later on this month. Having said that, it looks like investors are a little bit tired of buying stocks. We've got stocks down by a 3-to-1 margin on Wall Street after a series of all-time highs on Wall Street that has pushed the S&P 500. I was looking at the numbers. We are up about 35% in the S&P from those April lows. So maybe taking a rest.
Kevin Gordon just walked in the studio.
Did.
He's probably going to tell us that stocks can't go up every single day.
Wow.
But in addition to some other analysis, so we'll wait for that.
It did feel like, though, a period of record after record after record.
It was.
All right. Hey, listen, we're going to talk to Kevin. Coming up this hour, we have a bunch of great voices, including Kevin's. We're also going to hear from Citadel's Ken Griffin, JPMorgan's Jamie Dimon, and former U.S. Treasury Secretary Rubin, on the economy, on U.S. markets, and more, even a little bit of AI thrown into all of that.
Plus, the latest on the government shutdown. We did get some updates earlier in the day from President Trump, sitting alongside the Prime Minister of Canada, Mark Carney. So we'll get some updates on whether or not we're going to see this government reopen anytime soon.
Yeah, that's a good point. And we're also going to take a look at Mulinda Gates' $2 billion commitment to expand women's power and influence. It's all happening at Pivotal Ventures, so we're going to get to that a little bit later on. First up, though, let's get to that trade, that lower trade on Wall Street. Here's Charlie Pellet.
Hey, thank you very much. Certainly the names come out from Bloomberg. What a great lineup today. We have got the Dow, the S&P, NASDAQ. Not so great for the bulls. Very much in the red right now. A lot of people wondering if the rally has run out of steam. All of the hopes, all of the optimism over AI giving way today to concerns about the rally being excessive. So here's where we stand. We've got the S&P now at 6705, down 34, drop there of 0.5%. The Dow is tumbling 182, down 0.4%. The NASDAQ Composite Index down by 0.8%. Our Mag 7 Index is tumbling 0.9% with the 10-year currently yielding 4.11%. Gold up $17 the ounce. Spot gold now at $39.77. We are trading at a record on the precious metal, up by about 0.4%. A retreat for crude oil, little change, down 0.1%, $61.60 a barrel. Bitcoin hard hit, down 3.3%. Bitcoin at 121,126. Oracle shares are trading lower. Oracle down after a report from the information that the software maker's profit margin in its cloud computing business is lower than many on Wall Street have been estimating. Right now, we got Oracle down by just about 3%. Again, recapping here, stocks lower. S&P down 0.5%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
Yeah, interesting to see Oracle a little bit lower. However, it is up almost 70% here in 2025. All right, that is the latest on the overall trade. Charlie mentioned gold. The move up that we are seeing in gold today, it is approaching $4,000 as investors weigh the U.S. government shutdown and the political crisis in France. Meantime, you had Goldman coming out raising its price forecast for December 2026 to $4,900 an ounce. That's up from $4,300, citing ETF inflows and central bank buying. Now, investors have certainly taken a shine to gold. We've been talking about that a lot here at Bloomberg. Spot gold in the U.S. up more than 50% year to date. At the same time, the U.S. dollar has dropped. We've talked about that a lot. That relationship, by the way, it has not gone unnoticed by Citadel's Ken Griffin, who spoke with Bloomberg's Francine Lacroix about it yesterday.
The dollar's depreciated by about 10% in the first half of this year. It's the single biggest decline in the U.S. dollar in 6 months in 50 years. Gold is at record highs. And the appreciation in other dollar substitutes, to use that word loosely, in items like crypto, for example, is unbelievable. So we're seeing substantial asset inflation away from the dollar as people are looking for ways to effectively de-dollarize or de-risk their portfolios vis-a-vis U.S. sovereign risk.
That was Ken Griffin of Citadel yesterday on how investors are starting to view gold as a safer asset than the U.S. dollar. It's a development that he said is, quote, really concerning to him. The weaker dollar, the rise in gold, the role of the U.S. in the global economy and global markets, some big themes that we're going to touch on with Kevin Gordon. He's back with us. He's Charles Schwab, Senior Investment Strategist. He joins us here in the Bloomberg Businessweek studio. Kevin, good to have you back with us. Markets feeling the push and pull of a lot of different factors. Ken Griffin's certainly concerned about how investors are seemingly viewing gold as a safer asset than the U.S. dollar. Is this a concern you share?
Not fully, because I think if you look at the dollar there's always sort of a stock versus a flow that I think you have to approach for any asset class. I would, keep the dollar and Forex in that where, coming into this year, positioning in U.S. dollars and that currency relative to most of the world was quite strong. So some of it, I think, is sort of a hedge against some of the geopolitical risk premium that is now put on the United States, but also maybe just taking a little bit of a step away from everything U.S. And we can see that reflected in equity markets. You can see that reflected in some fixed income markets. So I don't think it's this, Armageddon-like shift away from the dollar, but I do think that there is something to be said about some of the trends maybe that are being initiated or put into place now, whether it's questions around things like Fed independence or it's questions around corporate earnings in the U.S. and how strong they're going to be for the bulk of the U.S., not just a slim number of companies in the tech space or anything that's being touched by AI. So I do think that it's valid, but I also think that the correction that we've seen in the dollar, I wouldn't extrapolate it into it's going to be this sort of epic turnaround in the currency. I think there needs to be a lot more that happens until that becomes the case.
What do you make, though, of the run-up in gold, which go back a few years, you couldn't touch it for a long time and nobody wanted to touch it, but yet it's been pretty substantial this year.
It's always interesting because, gold as this asset class, it's hard to compare it to a lot of things because, it doesn't earn anything. It's really just the price moves that's going to, dictate everything. So it's really just an indicator of sentiment is how we look at it. So right. I like to use it as a sentiment gauge, but it's interesting, too, because it's not like it's happened, the surge that we've seen this year, it hasn't happened in conjunction with an overly defensive trade in the U.S. equity market. If you look at the traditional defensives.
How do you explain that?
Exactly. So I do think that it could be currency related where there is a little bit of a fear, like Ken was mentioning, about the dollar maybe losing some of that status as its haven. But there's so much data to back up that that's not the case. The BIS just released its triennial survey of Forex and looking at the share that the dollar has in the world of everything from foreign transactions, cross-border transactions, all the way to central bank holdings and, global debt, global equity. The dollar is still, top dog. So I think that that's where the stock versus flow comes into it and where you could see something like gold, from the sentiment perspective, clearly it's getting caught up in such a strong momentum trade, and momentum is a powerful factor. Very powerful in equity markets, very powerful in other asset classes.
One last question on gold before we move to another big momentum trade this year. Are you suggesting investors buy gold in some form or another?
We don't have formal calls on gold itself. Okay. I think
you can make one right now if you want.
From the average investor's perspective, and it's tough because we've got millions of clients. So to give some sort of blanket recommendation for a client is always a hard thing to do.
But we're talking about metals and mining and different things more broadly than we have in a long time.
Yeah, for sure. I think that certainly diversification in other asset classes, and I think this also speaks to me, I backed this up several years where you look at something like fixed income has become now a very serious asset class for a lot of people who are looking for yield.
Right.
Who, if you've been in the market for a long time, 20 plus years, there was a long period where you couldn't get any yield. For a younger investor who is just entering markets in the past several years, you're stepping into an environment where there are so many more options and so many more opportunities. I think that something like gold fits into that in terms of what is your set of options that exists.
Right.
So for a younger investor, I think it's, somebody who's newer to this, I think it's a great world to look at where you can see that there are all these options. But even for somebody who's been in markets for a long time, investing for a while, you're now starting to see that there are other things that work, not just a U.S. equity story, for example.
You know what really works?
Is it AI, Carol?
Maybe.
Well, it's worked so far, and that's the question and really where we want to go to with Kevin. I saw you post earlier today this graphic from the Financial Times.
He was actually... Carol, come over and look at this.
I said, come look at this, and then I sent it to the whole team, and then I retweeted it. Not that I'm
here we are.
Here we are. And I said, we got to get Kevin on the program. But it's basically, it's this, if you were to take a whiteboard, and OpenAI is at the center of the whiteboard, you connect every company investment, a relationship with OpenAI, and the list is long. Microsoft, Oracle, NVIDIA, CoreWeave, Anthropic, Meta, Amazon, Google, Broadcom, and more. And it talks about the interconnected relationships, investing, customer, partner. Some of these are multiple relationships. So we used the term yesterday a lot, circular financing, and sort of concerns about what happened in the 90s with the dot-com boom then bust. Is this time different?
Yeah, it's someone sent the meme to me. It's the power cord plugged into itself, powering itself.
Don't do that.
But then
by the
if
way.
you do
not
exactly,
do that.
don't
Not
do
a good
that.
thing.
But the whole question about that picture is, well, where's the power coming from? Then if it's just plugged into itself.
We did a version of this for those who are watching on radio, like our whole thing, like just OpenAI kind of at the center of the world when it comes to the money flows around AI.
I do. And I know we talked a little bit about this sort of circular vendor financing the last time I was with you guys, but I think you do need to, anytime you bring in the discussion of the tech bubble in the late 90s and then the early 2000s after, I think we always need to keep in mind that no two cycles are the same. No two expansions, no two recessions. The tech recession was so unique in nature where that actual economic recession, the data, was not that bad during the recession. The economy still contracted, but if you look at the drawdown in GDP, it wasn't that bad. I like to think of it as a recession in the stock market because you had epic declines in the NASDAQ 100, the S&P. So I think that there's a risk to it now? Well, yeah. You've got the top 10 stocks in the S&P 500 that are 41% of the index. So by definition and mathematically, you're putting more weight and more sway in those companies if they do move significantly. An example like today with some of the tech stocks that have started to move, as we've gone throughout the session. So that in and of itself is a risk from a concentration standpoint. What we've been telling clients is, if you're not comfortable with that volatility, both to the upside and the downside, then there are ways to distance yourself from that AI epicenter, getting away from things that are power related, getting away from things that are tech related. But that's not necessarily something that anybody can time. So the being invested throughout the tech sector over multiple decades has really paid off, but it comes with a lot of dips in that roller coaster along the way.
There can be swings. We know that well.
Big
Kevin
swings.
Gordon, so good to have you here. Charles Schwab, Senior Investment Strategist. All right, the U.S. economy, AI, and the government shutdown. These are also AI, as I mentioned too, things that came up today in a conversation with JPMorgan Chairman and CEO Dimon. He sat down with Bloomberg's Tom Mackenzie at the JPMorgan Tech Stars Conference earlier today in London, and here's what he had to say.
What is top of mind for you, for the team, and for clients?
Yeah, so first of all, welcome, Tom. Thanks for having me here. Well, top of mind is the freedom of the democratic world, safe security, Ukraine, Russia, war, economics. That's the most important thing to me. I don't worry as much about whether we're going to have a recession or not next year. Here it's all about clients. Covering clients, innovating, growing the economies, which I also think is critical for everything. To get our economies serving all the citizens by doing a good job across the board. And I think this highlights some of that taking place, actually.
And you've lent into, for over a decade, you've lent into technology in terms of talking about it and investing billions. Yeah. When it comes to AI, which parts of the JPMorgan business are going to be most transformed by AI?
Yeah, so we've been doing AI since 2012. So people think it's like a new thing. Gen AI is kind of new, but not all of AI. We have 2,000 people doing it. Spend $2 billion a year on it. It affects everything: risk, fraud, marketing, idea generation, customer service, and it's kind of the tip of the iceberg. And so, we're deploying it. Every time we meet as a business, we ask, what are you doing in AI? What are you doing to serve your people? Why can you do better? What is somebody else doing? So we're freely deploying it and safely. We have a lot of rules and regulations in place about our own data and how we use it, et cetera.
Is it having a material impact on revenues for JPMorgan? If not now, then when?
So we have shown that for $2 billion of expense, we have about $2 billion of benefit. Some we actually can do real detail. We did this, we reduced headcount, we saved this time and money, we reduced errors. Some you can't. It's just improved service, something like that. It's like almost worthless to say what's the NPV, but we know about $2 billion of actual cost saves. And like I said, I think it's the tip of the iceberg. We're getting better and better at it. We know how to do it. As the managers learn how to do it, they're asking more questions. Why can't it do X and why can't it do Y? And then I don't have my phone here, we have a suite, an LLM suite on internal data to do research and summarize reports and scan contracts and do things like that. 150,000 people a week use it. So it's quite productive.
More and more of your employees are using the agentic AI.
Our own LLM, and agentic is just starting. But that will be deployed over time too. But it's also being used for coding. I mean, it's being used quite broadly now, and like I said, part of it is getting your mind working around how you're going to use this thing. And so our managers and leaders have to do it.
If you look out 5 years, are there more jobs in banking as a result of AI or fewer?
I think people shouldn't put their head in the sand. It is going to affect jobs. So think of every application, every service you do, well, you'll be using AI, some to enhance it, some of it'll be you doing the same job, you're doing a better job at it. There will be jobs that it eliminates. But you're better off being way ahead of the curve and retraining people. So we retrain and redeploy a lot of people. So for JPMorgan, if we're successful, we'll have more jobs. But there'll probably be less jobs in certain functions.
When you look at the spend on AI, infrastructure, chips, OpenAI, it's not making a profit. Loss-making, deals of about $1 trillion this year. The hyperscalers, the spend there. What is your reaction when you see those numbers crossing? Are you comfortable with that kind of spend on the infrastructure around AI?
It's a lot. I'm not sure it's all ever going to be totally spent. I think when you look at big tech, like tech that happens like this, and you go look at cars, you look at television, you look at internet, big money's got spent. There were a lot of losers, a lot of winners. In total, it was productive. So take the internet bubble. Remember that blew up, and the amount of people. You and I could probably name 100 companies that were worth $50 billion and disappeared. But out of it came Facebook, YouTube, Google. So there will be real big companies, real big success. It will work in spite of the fact that not everyone who invests in it is going to have a great investment return.
And of course, those investments are part of what has powered this bull market in stocks. And on Sunday, it'll be 3 years of that bull market. Where do you think we are in that bull market? Is there any complacency there? Is it underpinned by rational factors? Is there more momentum?
Yeah, look, we're in a bull market. It's been clear. Asset prices are high, credit spreads are low, consumer's still okay, the consumer has jobs. Remember, the jobs are what usually starts to force people to cut back and change things, and consumers spend less and companies cut back. So far, so good. There are a lot of issues out there that the economy's got to deal with, from all the geopolitical stuff. Maybe that'll start out well. What's going to happen to inflation? I'm a little more nervous about inflation not coming down like people expect. That might be a surprise. On the other hand, there's a lot of spending. There's a lot of government spending, which is inflationary too, by the way. And so, I don't know. I hope for the best, plan for the worst.
And you're not worried about a recession in 2026 for the US? You made that clear at the top.
I think it could happen in 2026. I'm not worried about it as a different statement. We'll deal with it. We'll serve our clients. We'll navigate through it. A lot of us have been through them before. You don't wish it because certain people get hurt, but it could happen in 2026.
We're still, of course, in the U.S. government shutdown.
But I do think there are positives. Like deregulation is a real positive, which also helps animal spirits as a positive. And in the one big beautiful bill, there's also more stimulus that has positives for the economy, but maybe negatives for inflation. So how it all sorts out, we'll see.
That, of course, is JPMorgan Chairman and CEO Jamie Dimon with Bloomberg's Tom Mackenzie at the JPM Techstars, JPMorgan, that is, Techstars conference today, earlier in London. Hey, JPM, by the way, does report earnings 1 week from today before the market opens, before, of course, the 9:30 open. That's along with Goldman Sachs and Wells Fargo. All right, listening to what Jamie Dimon had to say here in studio is Bloomberg News Chief Wall Street correspondent Sri Natarajan. Sri, first up, Jamie talks, we all listen. We're not exaggerating that when it comes to voices on Wall Street, this is the one everybody globally really listens to.
Yeah, without a doubt. He's the Dean of Wall Street CEOs. He's been in that seat for almost 20 years and looks like he'll be there for at least another year or two or more. So when you look across the landscape, it's very hard to find someone with that level of longevity. And then you have to remind yourself that he's at the helm of the nation's largest bank. So that magnifies the weight of his voice.
So anything he said that you found interesting ahead of earnings next week?
Before we get into the earnings part, I will say I was quite fascinated by some of his commentary around AI, because this is a question we like to ask all bank executives. Can you put a number on it? Can you tell us what the savings are? And for the last several months, the answer we've been getting from a number of these folks has been, there have been obvious productivity gains. Easiest to quantify will be an engineer can code 40% faster, or can do, you can very specifically drill down on that front, and you can save time. But they've all been struggling to put a real number on it. They've been struggling to tell investors and analysts that come 2026, I will be able to reduce $500 million in costs or $1 billion in costs. So it was very interesting to hear Jamie talk about it. Of course, I think when he's talking about AI, he's taking a little bit more of a broader lens, not the post-chat GPT perplexity world of AI, but even going back to 2012. So I'm assuming he's talking about this idea of increased adoption of automation.
Which
right?
banks have been doing for a long time.
Doing for quite a long time. And in his case, he says JPM has been using some form of AI since 2012. But he did say in that period, we are seeing roughly $2 billion in cost savings. So we're spending $2 billion in AI and we're seeing that cost savings. So at least he's able to justify it to his board, his investors, his analysts that, there could potentially be more savings ahead. But we're already seeing enough to convince us that we can continue spending at this level and it's all a net positive for JPMorgan. That was fascinating for me.
Yeah, for $2 billion expense, we have about $2 billion of cost savings for AI. But he also said it's the tip of the iceberg and that JPMorgan is getting better at AI. What does he mean when he says it's the tip of the iceberg? Is that from the way they're using it internally? Is it from what customers are going to see? Is it everything? I mean, what's the vision that banking executives have for this technology?
So, and again, we have to guess a little bit here, but we have to assume as a large consumer bank, as a large retail bank, the places where you can obviously see the obvious impact is customer service in detecting fraud, in handling queries and complaints and whatnot. But you can take it beyond that into the kinds of things that will take it beyond the realm of simple customer service issues, into how it can aid traders, into how it can aid investment bankers. And therefore, it could perhaps in aspects of asset management and wealth management, at which point it touches every large segment of JPMorgan. So the benefits that they're already seeing in the retail banking segment could expand well beyond that into every other part of JPMorgan. And that's when you see this $2 billion of cost savings that he touts, a number that could go much larger than that and will keep him happy to continue investing in this space.
How do you take, he said a lot of merger talk, firepower in the market, and I know maybe not everything was in that interview, and I highly recommend people check it out on the Bloomberg for the entirety or the entire interview. But he also talked about consumers okay now, but recession could happen in 2026. But again, he seemed like, yeah, it'll be okay. Is that again like a reminder there's the K-shaped economy for a recession's going to hurt some people and maybe more so than
it's a little bit of also which side of the bed does Jamie Dimon get out of, because there are some interviews where he does sound like the weatherman warning about the dark clouds on the horizon. And there are other interviews where he will like to stress the fact, whatever happens in the economy, we, Fortress JPMorgan, are going to be completely fine, which is why I found his statement funny when he said, when he was asked about, are you worried about a recession? And no. So, when our anchor asked him, so does that mean there's no recession? He said, no, there could well be a recession in 2026. I'm just saying I wouldn't be worried about it because I'm prepared to deal with it. Two different statements.
Bank earnings next week. We like to hear from these banks quarterly.
A week from today.
I can speak to that as a journalist, as a broadcaster. Are we going to keep hearing from them quarterly?
Jamie actually addressed that point, and I guess you're referencing this push by President Trump to say we need to move away from quarterly earnings. We perhaps make it every 6 months because it has become too cumbersome. Jamie, the way he addressed it, he said, look, we'll probably still give quarterly updates to our investors, perhaps not with that level of detail. But I think it would be fascinating for anyone to listen to that full clip because he did hit on some very critical issues. He says, in the last 30 years, the number of public companies has actually gone down. We've gone from 8,000 public companies to 4,000 public companies. A lot of this perhaps has to do with the fact that in the pre-IPO stage, the amount of funding and financing that's available to companies makes it easier for them to stay private for longer. But he also adds to the fact that there are just onerous requirements of public companies that makes planning for the long term hard. And he was very specific about it because when a CFO goes on an earning call and gives you a guidance, gives you an estimate, Jamie Dimon actually took us behind the scenes to tell us what happens when you float a number like that. Then you're spending the next 12 weeks making sure that you're going to hit your mark because you don't want a black eye in the market when you come for your next earnings call, which will make you do some stupid things, which will make you want to move some resources from one side to another. Let's say you come out with an NII estimate and you're not meeting it 6 weeks into the quarter. You want to shift more resources towards making sure you meet that NII target, even if that's not the best use of the company capital allocation.
All I would say is an environment where we look at OpenAI, right? And what is it, $500 billion potential in terms of its market valuation, so much money floating in, out, all around that company. it's not public, and we really don't know everything behind the scenes when it comes to its financials.
And that's why company management will tell you we'd like to have it exactly that way. Listen to our advertising touts, not drill into our numbers.
All right, Sri, we know it's going to be, you're getting ready for a very, very busy couple of weeks. Sri Natarajan, he's Bloomberg News Chief Wall Street Correspondent. Hey, in just a moment, we're going to hear from former U.S. Treasury Secretary Rubin to talk about the state of the U.S. We'll get to that, Tim, in just a moment.
First up, though, a check of the day's trade and top business stories. Here he is, Charlie Pellet.
Thank you very much. JPMorgan Chase shares down 0.7%. They report a week from today, along with Citigroup down 0.8%. Wells Fargo that day as well. Wells Fargo right now up 0.2%. The Dow, the S&P, NASDAQ all in the red. Traders sending stocks lower after a series of records spurred signs of buyer exhaustion and calls for a breather. S&P down 28 now, down 0.4%. The Dow down 0.3. We got NASDAQ down 0.6. 10-year 4.11%, with the 2-year 3.56%. Gold at $39.81 the ounce. Gold at a record. West Texas Intermediate crude flat on the day now, $61.71 a barrel. And Bitcoin is tumbling by just about 3.5% right now, 120,931 on Bitcoin. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, let's head right now to the Greenwich Economic Forum in Greenwich, Connecticut. Bloomberg TV's Lisa Abramowicz talking with former U.S. Treasury Secretary Rubin. That conversation in progress.
So, and I'm not saying that's the case now. These markets may go on forever. Maybe we finally found Nirvana. But I'll tell you, my view of whatever it's worth, I think one has to think very carefully about what you think the risks are, what you think the rewards are, and try to make reasonable judgments. And I'm not predicting in any way what the markets are going to do. I'm just going to say that I think that the risks are enormous, and I think, I guess I do think, that's not I guess, I do think that the markets don't properly weight those.
So let's talk about some of the specific risks. People, when the tariffs were announced on Liberation Day, April 2nd, there was this feeling that business would collapse.
It wasn't my view, but go ahead.
Well, why has the market been so surprised? Why have companies been so surprised themselves? CEOs I talk to say, we've been shocked that things kind of keep going.
Yeah, people, Lisa, they may keep. I think the tariffs were extremely unwise. I think open trade has served our country extremely well over many, 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 many decades. I do think there's some caveats to that. I do think you need to protect supply chains when they have national security or economic security dimensions through subsidies or trade restrictions. But having said that, beyond that, I think open trade has served us extremely well. I think tariffs will hurt us in terms of growth, and I think it's a one-time increase in cost. It's not in that sense. It's not inflation, but it is a one-time increase in cost. Cost to our producers will go up. That decreases their efficiency and competitiveness. It could lead. I've never forgotten something Paul Volcker said to me. He said that inflation can take on a life of its own, and of course that was a reference to inflationary expectations. Maybe and maybe not, the tariffs could create a set of inflationary expectations, and it could lead to inflation. But whether it does or it doesn't, it almost surely will adversely affect growth. But I for one, never thought it was going to have an immediate impact. But I thought the risk was over time, and I still think that's the risk. And if you speak to CEOs, and in our firm we do a lot of that. We have an immense business dealing with basically large corporate America. I think most CEOs, virtually all CEOs, think they're going to be passing on a lot of this in terms of prices. So cost to consumers will go up, and cost to producers who are importing, in components will be going up.
What's fascinating is when the tariffs were announced, people thought that it would be really bond negative because inflation would go up and you would see sort of this stagflation-like kind of environment. And so bonds would be in a sort of quagmire, as would the Fed, as would the rest of policymakers. Instead, tariffs are now treated as a positive because they are a revenue boost that will offset any deficit spending. I could tell you agree with that. So I'm wondering.
I only disagree with it because it's wrong, but go ahead.
Well, so I'm just curious, where this is getting misunderstood.
Well, the Yale Budget Lab, which is terrifically reliable and sensible about the fiscal matters. I asked her the other day, the one who runs it, Natasha Sarin, who's a tenured professor at Yale and terrific, also a PhD in economics. She told me that she thinks that revenues will be about maybe 280 billion a year, some number like that, and that's before the adverse effects on growth and retaliation. When you take it all into account, maybe 200. It's a very small fraction of our deficits. This is not going to be a fiscal response, and you're paying a price for it. in terms of, as I said a moment ago, risk to growth, and at least I think well, certainly higher cost to consumers and to producers, and possibly triggering inflationary expectations. Look, what is it? The tariff is, assuming that it gets passed on, which if you talk to our clients, I think virtually all this is going to get passed on over time. It's a regressive tax. And it's a regressive tax which has adverse effects on growth, and as I say a moment ago, on inflation.
So I'm trying to pair this with the idea that we're seeing mergers and acquisitions accelerate. We hear a growing number of companies talk about, and corporate executives, a reacceleration in the consumer.
Yep.
How do these two things go together?
I don't think it's complicated. When I was at Goldman Sachs, we had economists and we had terrific people, strategists and everything. They would always tell me what they thought was going to happen in the short term. And I would always say, you're very nice people, and I think that's nice for you to do. And our clients are interested, so you should do that. But I myself wouldn't base my decisions on them. Things, short-term and short-term effects, Lisa, can be whatever they're going to be. The question is what's going to happen over time. And I think over time, for the reasons I've said, I think tariffs are a very substantial negative, and I think that open trade has served, with the caveats that I mentioned, I think open trade has served us very well.
How much are companies rethinking their U.S. footprint in a new kind of way?
Well, my impression, and I get this largely from speaking, I don't speak to many companies myself, but our people are just enormously plugged into corporate America. And I also have 3 advisory relationships with pretty substantial investment, I guess you call them funds. I think a lot of people are rethinking how much they want to be allocated to the United States. And you see it a little bit, by the way, in the dollar. The dollar has, after all, suffered through this thing. I don't think too much of it has happened so far, but I think it's a risk that we're taking. And I think what's so sad to me, Lisa, is we have such tremendous strengths and so many advantages. And I think the damage we're doing is very substantial, attacking our research, attacking science and basic research, attacking our universities. Immigration policy that makes no sense whatsoever. We should have economic, or let's put differently, we should have immigration that serves our economic needs. And then we should have, at least in my opinion, measures to deal with the currently undocumented people so they can become, who are part of our economy. And if they're obviously doing adverse things or criminal things, that's a different matter. They can continue to prosper in our economy and eventually become citizens. There's so much that we can do, but we're doing the opposite of all these things.
There is this feeling, and we're seeing this in the political sphere, and as someone who was in the Clinton administration when globalization was really taking off, I'm wondering what your perspective is on how the story of globalization is being told now, and that a lot of people are saying there were a lot of people left behind, and that there are some things that need to be done to remedy that.
I totally agree with that. When President Clinton announced NAFTA in the East Room, I totally agree with that, Lisa. One of the things but I think the wrong conclusion is therefore let's not open trading markets. I think the right conclusion is let's do what President Clinton talked about when he announced NAFTA, but that we never were able to do politically. We lost control of the Congress and we lost the ability to do it. And that is have in place retraining, social safety nets, a greatly increased earned income tax credit so that people with low incomes will have higher incomes, and have all of that to deal with job losses. And as much as that is a problem with respect to trade, AI, in my opinion, and you all have your own views, some of you probably know a heck of a lot more about it than I do, but as I say, I've been taking tutorial for the last 2 years, twice a week, so I kind of know something about it. I think that the potential for job losses is very substantial. And so as much as we needed that kind of an adjustment set of programs to deal with trade, and we did need that, Lisa, absolutely, and we don't have it, I think we're going to need even more to deal with AI.
Which is something that we're not hearing as much about as a lot of people think that
Lisa, it's not part of the political dialogue, and it should be. Look, our political system is in terrible shape, and that's not a partisan comment, though I do think Trump is doing just immense damage to our country with his economic policies and his actions. But in neither party are we talking about a lot of what we need to talk about. And one of the things we need to do is to do exactly what I just said, but there's no political ability to get, not a lot of political focus on it, and really no political ability to get it done.
Given the footprint that you have and the access to companies, do you have a sense of how much they plan to reduce their staff, or whether they are not necessarily hiring recent college graduates as a result of their using
Yeah, I get
AI.
the question. I don't have much wisdom on that. I've asked our people that too. I mean, clearly the labor market has softened. There's no question about that. I'll give you my personal opinion, whatever it's worth, but it's really mostly based on just what I think about AI. I think AI has the potential for tremendous positives in terms of productivity, which, by the way, could be partially responsive, albeit not fully responsive, to our fiscal trajectory. And our fiscal trajectory on multiple bases, it seems to me, is a tremendous risk to our economy over time. So this could be partly responsive to that, and productivity, increased growth, increased revenues, and so forth. But I think a lot of, I do think it's going to have very substantial job displacement effects. A lot of things that are being done now by people are going to be done by AI. And AI, as you know, what is the human mind? The human mind is neural systems, right? What is AI? AI is neural systems. And if you take AI and you pursue it, and some of you know much more about this than I do, but you build bigger and bigger data centers and more capacity, you create neural systems that are able to do not only the more mundane tasks, Lisa, but all the kinds of, many of the kinds of complex thinking that we're accustomed to associating with human beings. And that is, as you know, is sort of the question of AGI. And admittedly, you can define AGI a lot of different ways. I get that. But however you want to define it, I don't think any question that AI is moving, at least in my opinion, I may be wrong, but I don't think I'm wrong, moving very quickly toward ever more sophisticated capabilities that can more and more replicate the neural processes of the human mind.
Which is the reason why when you talk to some Fed officials on and off the record, more off the record, they will talk about running the economy hot or prioritizing the labor market as a way to ameliorate some of the potential job losses from AI, because it encourages companies to invest more in their workers and keeps people employed so people won't be left behind as much. I mean, do you buy into that kind of idea and sort of endorse the idea of having a more accommodative monetary policy at a time like this?
Yeah, I get the point, and this is a good debate. This is the kind of things that if you have sensible people sitting in a room, you could really discuss in very interesting ways. No, I actually don't agree with Lisa. I'm much more concerned about the possibility of inflation. And if you run the economy too hot and you get higher rates of inflation, and that in turn has a weaker dollar and it has higher interest rates, I think that can have a lot more adverse effect than the benefit you're getting from Fed funds rates being lower and whatever you think might contribute. So you might actually accomplish the opposite of what you wish. So I know if I were at the Fed, look, nobody's going to ask me what I think at the Fed, I promise you, but if anybody did, I think I would say to them, you've got a dual mandate under Humphrey Hawkins, as we all know, and I would worry more about the inflationary side of that than I would. I'd worry about both, but I'd be quite concerned about inflation.
One thing, Ray Dalio was speaking earlier, and he drew the parallel to the 1970s as well as the 1930s, which is a little bit even more alarming. I'm just wondering, from your perspective, do you think that the 1970s style inflation is the correct analog? Well,
1970 is an interesting time, and that's actually what Paul Volcker was talking about when he and I were talking about this. You know, I don't know, probably not many of you here, well, maybe none of you actually, lived through the 1970s. I did. And inflation took on a life of its own, Lisa. And inflation, this was Paul's point, inflation expectations built on themselves, and once that happens, it's very, very hard to deal with. And Paul's point was, and I think he's right about this, that once inflation gets going, inflation expectations are very, very difficult to deal with. That's why if I were the Fed, I'd be focused on both aspects of my dual mandate, Humphrey Hawkins. But I would be quite concerned with not allowing inflation to move in a way that is threatening.
We spoke a bit ago, and you said the U.S. is still the best place to invest. Do you still feel that?
Yes, I do, but it's complicated. We have such I really am troubled about, troubled is the wrong word. It is tragic what we're doing to ourselves and what this administration is doing on so many dimensions, in my opinion, in terms of public policy, because I think we have enormous strengths compared to others. I'm repeating myself, and I know that. We have flexible labor and capital markets. We have a dynamic culture. We have capital markets that are unrivaled any place else in the world. We have great universities, though now we're attacking them in ways that are hugely counterproductive, in my opinion, and so much else going, natural resources. We have so much else going our way. But we are doing a lot of damage. Yes, I would still invest here, because I think, look, I think ultimately it's going to depend what happens to our political system. And I think sooner or later we'll come back. I hope is the wrong word. I think the odds are we will come back at some point to the historical system that we've had. We have a conservative party sort of a Ronald Reagan is a historical conservative. You have a progressive or liberal Democratic Party, whatever you want to call it, center or left, I don't care. And then they have the debates, and we're back where we used to be. It won't be the same. It will not be the same. But it'll be some analog to that. So I believe that's the most likely outcome. And China has China has some great strengths. We all know that. But it also has enormous problems. We also all know. And Europe, from 2019 to 2022, productivity in Europe grew 0.4%. Productivity in the United States grew 6%. And the Mario Draghi report, which was designed to deal, I was with Mario the other day. We spent an hour together just talking about this because he was in New York and we got together. It was designed to address the productivity problems in Europe. They've done virtually nothing on it. So yeah, I'd still bet on us, but I think I'd still bet on us. I'd still rather be here. I am here in terms of my own personal resources, but I think what we're doing to ourselves is very seriously troubling.
There's a lot of question around gold and the fact that a lot of people are going into it and whether this is sort of a signal of something with the debasement of the dollar or of people's state of mind.
Yeah, I know.
What's the message? What's the signal from gold?
I don't have the foggiest notion. Look, gold has always been this sort of so-called refuge from the dollar. I shouldn't mean the dollar, I mean from uncertainty. And, it's had thousands of years of history of that. Is the current action of gold a signal of something? I have not the foggiest notion. I personally wouldn't own it, but that's just because gold has no use value. It's only a psychological, but look, I'm not demeaning it. It's for thousands of years. It's been a psychological refuge from uncertainty. But I don't know I wouldn't call it, I think one can think rationally and thoughtfully about all these things. I personally wouldn't weigh the price of gold in my thinking about what the odds are.
We were talking about the path ahead and
all right, you are listening to former U.S. Treasury Secretary Robert Rubin with our own Lisa Abramowicz. They are there at the Greenwich Economic Forum in Greenwich, Connecticut. If you want to hear the rest of the conversation, you can certainly check it out on the Bloomberg later on or at Bloomberg.com. So we will, of course, too, monitor for any additional headlines.
Well, Carol, we and others have reported on women controlling ever greater sums of money around the world, setting the stage for major shifts when it comes to wealth management and philanthropy. Check out these numbers. In the U.S. alone, Mackenzie expects women to control $34 trillion, or roughly 38% of investable assets by 2030. That's close to double last year's total. That figure, just $7.3 trillion, or 29%. Just 10 years ago.
It's something that we're going to talk about in just a moment in terms of the amount of money, the shift towards women. We'll get to that in just a moment. But first up, we've mentioned stocks under some pressure. So let's check in on the trade. We've got about an hour and a half to go until we wrap up trade on this Tuesday. Let's toss things over to Charlie.
All right, I thank you very much. And here's what's going on. Let me quantify that sell-off right now. We got the S&P 500 index down by about 0.4%, down 28. Dow Industrials down 0.3%, lower by 145. NASDAQ down 0.7%. The Russell 2000 index tumbling 1.2%. Traders sending stocks lower after a series of records spurred calls for a breather amid signs of buyer exhaustion. The 10-year 4.12% with a 2-year currently yielding 3.56%. Former Treasury Secretary Bob Rubin discussing gold. Spot gold up 0.5%, a record $39.80 right now on the precious metal. West Texas Intermediate crude up 0.3%, $61.90 a barrel. Cannot ignore the move to the downside in Bitcoin, now slumping by 3.6%, 120,779 on Bitcoin. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
So appreciate it. Charlie Pellet there. As Tim mentioned just before Charlie, Mackenzie expects women to control $34 trillion, or roughly 38% of investable assets by 2030. That's close to double last year's total. We have definitely seen the figure grow over the last decade. Let's get to our weekly discussion on women, money, and power, where we explore the economic implications of these changes and how to navigate them. There's so much going on. Great to have back with us Erin Harkless. She's Vice President, Managing Director of Investments for Pivotal Ventures, right here in studio. Welcome. It's so good to see you. How are you?
I'm doing great. Carol, Tim, thanks for having me on today.
Thank you. Well, this is a big issue. We've been talking about it for years, about the amount of money that's either shifting into the hands of women, what it means, what the differences are. I am curious, and maybe not everybody's aware of all the work that you guys are doing. You have this very specific mission at Pivotal. Remind everybody what you're up to. And I am curious about what it means on a day-to-day basis what you're looking for to invest in, relationships, and so on.
Yes. Again, well, thank you for having me. Pivotal is an organization founded by Mulinda French Gates in 2015. We are focused on advancing social progress. And specifically, when Mulinda set up Pivotal, she realized that we would need multiple levers and tools to do that, including philanthropy and investment capital, to get more power in the hands of more people, particularly women. So we invest in women-led funds. We also invest in companies that are innovating in areas and themes like women's health and caregiving, where women carry a lot of burden. And there's great opportunity to drive innovation, and we think make a lot of money investing behind those themes as well. So that was the real impetus to found Pivotal for Mulinda. She wanted women to be in a position to make decisions, control resources and capital, and influence the decisions that are happening in our workplaces, in our communities, in our schools, and in our homes. And that's what we're setting out to do with our investments every day.
So when you identify those investments, when you identify where you want that money to go, what are the things that actually advance power and influence for women in your view?
It's having women in positions to make decisions. So as we invest in funds that, again, are predominantly women-owned and led firms, they're investing across a spectrum of sectors, everything from AI, enterprise, digital health, financial technology, fintech, the care economy, which is one of my favorite topics. I'm happy to talk a lot more about that too. But that's what women's power is for us. It's women, again, in a position to make these decisions. And it's also true for our direct investing as well. Many of the companies that we backed have female leaders and some do not. But we're just trying to find founders and innovators that are really solving problems for everyday Americans and everyday women.
I love that, and we want to get into some of the specifics in terms of where you guys are investing, but this idea of getting money in the hands of women, how many times do we sit around this table, and it doesn't matter what group we're talking about, money talks.
Yes.
It gives you a seat at the table, whatever table that may be. And it's just fascinating that here we are still in 2025 and it's still a struggle. But this idea that you guys are specifically targeting women and making sure that they are having the money they need to kind of grow their power, that's really important.
It is. It's incredibly important, Carol. And the numbers have improved. About a decade ago, about 9% of decision makers, partners at U.S. venture capital firms were women. That number's grown to about 18%. So we've made meaningful progress in the last 10 years, but we have a long way to go. And as you both shared in the opening, that $30+ trillion of assets that are held by baby boomers that are most of that transferring now to women. Women are going to want different things with their money. They want different advisors. They want products that meet their needs and solve some of the issues and problems that they're facing. And so we see, again, a huge opportunity if we can change the face of who is making the decisions. That brings real power and real change.
Can we talk about caregiving for a minute?
Yes.
It's an area of your focus. It's an area of focus at Pivotal Ventures. It's something that Carol and I think a lot about.
Been involved in it.
Yes.
How do you make this work structurally in an economy like ours?
We have to start with the care infrastructure. We've supported research at Pivotal Ventures that sizes the care economy at $648 billion. I'm going to pause and let that sink in. Every time
So that's for people's offspring, but also for people's parents and other loved ones they might be taking care of.
Exactly, Tim. It's the full spectrum. I describe it as end of life, back to beginning of life, child care, elder care. We think of women's health solutions to help you optimize your home life better, to care and age in place. All of that is a part of that $648 billion market. And we've ignored caregiving for too long. It's the most important work. As you said, we all do. Everyone's a caregiver at some point in their lives. And as we thought about sectors or themes where women specifically carry a big burden, caregiving is one of them. And we want to fund the innovators and the founders that are building companies to address these solutions. And again, just make that loving work that we do easier.
Yeah, because the gaps that are out there is tremendous. And if you have money, it's a lot easier. If you don't, it's really, really a struggle. One thing I want to get to, and I think about how you guys are going about this. Last month, the Aspen Institute launched the Workplace Innovation Now Challenge, WIN Challenge. You guys are involved in it. A $60 million grant competition.
Yeah.
What's the goal here? What's the mission?
The goal is to find better solutions for women in the workplace. We are thrilled to partner with the Aspen Institute in this initiative and looking at ways that we can improve the workplace environment for women around AI, around culture, around narrative. So there'll be more coming out in the weeks and months ahead. I encourage social entrepreneurs, philanthropists to take note and support that work alongside us, because we need better solutions for women in all facets of our lives.
We've made progress, but we could do better.
We could do more.
It's just, this is, I feel like we have talked about women in money for a long time, women in power in a long time. And like you say, we've made progress. But, if you could change one thing, we've just got about 30 seconds, that would really improve women, money, power, like the whole thing. Yeah. What would it be?
I think it's knowing what you own and asking questions, not being satisfied with the status quo. I think that's probably the biggest thing. One thing that we try to do with our investment process, and that our founder, Mulinda French Gates, has empowered us to do, is to build a diligence process, a sourcing process that's more inclusive, that tries to build and find new patterns of success as investors. And I think that's one thing that I would encourage all of us, whether it's with your personal, your 401k, or if you're or other institutional investors, to take that tack as well.
I like that. Ask questions. Erin Harkless, VP and Managing Director of Investments for Pivotal Ventures. Stocks on the move when we come back.
You're listening to Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec on Bloomberg Radio and Television.
All right, everybody, coming up very close to the last hour of trading on this Tuesday. Already? Time flies when you're having fun.
We are having fun. We always have fun.
I got to tell you, Tim and I, we work really hard. We do a lot of stuff. We come into the studio, and this is when we have fun.
Tomorrow, you and I are headed to Los Angeles. Bloomberg Screen Time, our special coverage, begins at 10 a.m. California time.
Correct.
1 p.m. Wall Street time. On Thursday morning.
Yep. Mark your calendars.
We have just a fantastic group of folks who are going to be speaking at the event.
Jimmy Kimmel.
Jimmy Kimmel. We'll hear from him.
Co-CEO
Really excited about that.
Netflix.
Yep. Greg Peters will be there as well.
A few more.
Yeah, we got a lot of good ones.
They're really cool.
You're going to have to stand by. You'll have to come and visit. You'll have to come to the event, or you'll have to check it out at bloomberglive.com/screentime.
Like, we think about content today, it's just coming at us from so many different angles, right? I mean, you're a content creator. You're Norah and Mulinda, who's going to come in just a moment, a content creator. I'm a content creator, for better or for worse.
Also, check out the Screen Time edition of Bloomberg Businessweek. It is the Screen Time edition, and Mr. Beast is the cover story, that written by Lucas Shaw.
David Ellison.
Yeah, of course. These are all names who are going to be there.
Yeah. Okay. It's not to be missed. That's all we're going to say. All right. Right now we got stocks hovering near their lows of the session, down about 0.4% on the S&P 500, 67.13, 0.5% lower on the NASDAQ 100, 131 points to the downside, Tim.
I'm Tim Stenovec, along with Carol Massar. Let's take a look at some stocks on the move today. With us is Bloomberg television markets correspondent Norah Mulinda. Norah, you are Bloomberg TV markets correspondent, but in a previous life, you followed home builders very closely.
Still follow.
Okay, you still follow.
Can't get away. Can't get away from real estate stocks at this point. But looking at shares of home builders, not a great day. I'm looking at S15 Home. That's an index right now, down about 4.4% in trading. This is really after Evercore analysts came in. They downgraded a lot of the stocks in the industry. D.R. Horton, Toll Brothers, they do more of the luxury end of things. KB Home, they cater to a lot of the entry-level buyers, but they're essentially cutting them, downgrading them to inline from outperform. And this is based off of course, high rates as anticipated. Not too much more to the story there, apart from the fact that they're saying that they are seeing a lot of sluggish demand right now. It's really just underscoring the story that we've been talking about for months on end at this point, where there's not necessarily a scarcity of supply here, but it's more or less the idea that there is demand that's really weak, especially as a lot of consumers are grappling with a lot of constraints right now.
Yeah. Remember I said to you, though, like I had like 3 or 4 houses?
I was shocked to hear you say that.
In my neighborhood. And there's actually 1, 2, maybe 3 on my street.
Wow.
That's really surprising to hear.
And then there's also another piece of property that someone's bought and they're totally gutting and redoing.
So how long is have these homes been on the market? Are they moving?
One has been there for a while.
All right, so
maybe
they need to lower the price.
I think it went up like late spring, early summer. So it's been sitting there. So.
Yeah.
So there's a little bit of inventory in your neighborhood.
A little bit of inventory.
Okay.
Okay. Well, but these are previously used homes in your neighborhood, right?
Yeah.
So these new ones,
existing home,
they're high.
Yeah, they are high. They are high. Let's talk about a stock that came on our purview, if you will,
yesterday.
Very late yesterday, and moved down in a big way yesterday.
So we did see shares of AppLovin, that's ticker APP, slumping about 14% yesterday at the close, but we are seeing a rebound today. But what we were talking about, of course, and what you're pointing toward is the report from the Bloomberg News that the U.S. SEC has been probing some of the company's data collection practices here. And Citi did come out today. They're saying that they would be buyers on this weakness here. You really are seeing a boost in shares. AppLovin shares up about 8.9% right now as we speak. But all this aside, it's been such a stellar year for this company. Shares are up nearly 100% so far year to date. So investors are seeing some really great returns. But of course, you are just seeing a bit of a rebound story today as people really digest what was said yesterday and how Citi analysts are now coming out saying this might be an opportunity to buy here.
So AppLovin last year up 700%.
Yeah.
And up in 2023. 280%. The year before in 2022 wasn't so good.
What the heck does it do? Is it
down
just
90%.
Data? Just data? Data collection?
Well, according to our DES page, develops technologies that help businesses of every size connect with their ideal customers, add marketing business here.
Advertising tech company.
Yeah.
Okay, well, speaking of tech.
Yeah, good segue.
We
don't
have much time left. I wanted to get to Oracle. It's also on your radar.
A name that we can never forget, it feels as though that's the case. That's ticker ORCL. Shares are down about 2.8% right now, but we're earlier tumbling as much as 7%. This is after the information reported that its fast-growing cloud business that's powered by, of course, NVIDIA's chips has had, quote-unquote, razor-thin gross profit margins in the past year. They're citing internal documents here. So, I mean, this is really interesting, especially as you think about this in the face of all the news that we've been hearing with Oracle recently. In the red today, but up in the green year to date. Shares are up about 69% so far this year.
On a tear in 2025. Good batch of stocks. Love it, love it. Bloomberg TV markets correspondent Norah Mulinda joining us here in studio with some of the stocks on the move. Check out our Stock Movers podcast. They're 5-minute episodes of the biggest winners and losers in the stock market. You can find it on Apple, Spotify, or anywhere you get your podcasts.
We got a great program coming up on a Bloomberg Businessweek Daily. We're joined by the mayor of Baltimore. We're going to talk about the shutdown, the effect that's having on his city, and of course, the prospect of federal troops being sent in by President Trump. Also, the co-founder and CEO of Zwift back with us.
If you're watching on TV, the close is coming your way. Tim and I continuing on Bloomberg Businessweek Daily.